You're listening to the Scotiabank Market Points podcast. Market Points is part of the Knowledge Capital series designed to provide you with timely insights from Scotiabank Global Banking and Markets leaders and experts.
I'm Stephen Maurice, host of Scotiabank's weekly podcast, Perspectives. Today you'll be hearing an episode I recorded recently for Perspectives with Hugo Ste-Marie. Hugo is the Director of Portfolio and Quantitative Strategy and Equity Research at Scotiabank. He's also one of the authors of a recent Scotiabank report looking ahead at the markets in 2025. In it, Hugo and his co-authors outline the key themes they think will shape the investment landscape in the coming year, and he's here to break some of those down for us. He'll tell us where he thinks markets may head, where there may be opportunities as well as risks, potential surprises, the possible impact of a new administration in the US, and much more as we head into the new year. Before we begin, just a reminder to always consult your advisor before making any investment decisions. I'm Stephen Maurice, and this is Perspectives. Hugo, welcome back to the show. It's always great to have you on.
Thanks for inviting me.
All right. Before we begin, I just want to clarify that your job is mainly advising global institutional investors and not necessarily everyday retail investors. That said, I think your take on the broader macroeconomic outlook will be of interest to lots of people and can help them give a big picture sense of things.
Exactly.
Okay. So I think it's probably impossible to talk about the market outlook for 2025 without first getting a little bit of the lay of the land, of the broader macroeconomic situation, and I guess specifically how a second Trump administration might affect that. Maybe we can start there. How do those factors affect your outlook?
That's a great question. Even though we have, I would call it even a rosy base case scenario, there certainly are some risks shaping up for 2025. As you alluded, one of them is the new incoming Trump administration. If Trump were to implement steep tariffs on Canada, Mexico, Europe, China, clearly world growth won't improve as much as we are expecting right now. That could be a big risk on the earnings side. So if growth were to disappoint, or worse, growth was to contract due to tariffs, obviously you won't get 10 to 12% EPS growth in 2025. And that could lead to a decent retrenchment in stock prices. So that's a key risk. We should have more details in the next few weeks, maybe next couple of months, to see what's happening with tariffs.
Right. And I guess there's different forces at work. On one hand, I think many people expect that a Trump administration would be good for the business environment and growth on that side, but then with the potential downside of things like tariffs and so on.
Yeah, absolutely. That's why the market initially rallied relatively strongly following the November 5 election. People were banking on tax cuts. I think that should happen. But the big question mark is to know if the tariffs are just a ploy to extract most from the U.S. trading partners, or if Trump is decided to enforce tariffs on most trading partners. And again, even if we have tariffs, are they going to be quite high? Like you mentioned several times, 25% on Canadian exports. But again, if it's not 25, it's 5, it's more manageable than if it's 25. So again, There's a lot of uncertainty, not only if we're going to have or not tariffs, but if we have tariffs, is it going to be small tariffs or massive tariffs? And are they going to be broad-based or more focused on one or two industries, which would be more, I would say, easy to swallow, if you will, from an economic standpoint, from a Canadian economic standpoint?
Okay. All right. Maybe before we get into the specific themes in the report that I've mentioned a couple of times, maybe you can just tell us briefly what that report is, what it's intended to do. Is it a bit of a guidebook for investors as they look ahead into 2025?
Yeah, you can call it a guidebook, if you will, where at the time of writing in early December, we put our best efforts into this report, suggesting what could happen in 2025. Obviously, a lot could change over the year, but when we wrote this, and even as we speak today, our base case scenario is for decent growth, and I think that's going to be supportive of risk assets for further down the road.
Okay. So let's get into the report. And one of your first themes is about interest rates. You wrote, "It all comes down to a synchronized easing cycle." What do you mean by that?
When we talk about equities or investments, we have to start with the global macro landscape. So how the US economy, how the Canadian economy, Europe, China are expected to perform before talking about investments. So when you look at one of the main themes that we see and we got in 2024 and we see continuing into 2025, it's the global monetary easing. It's a synchronized easing cycle. We have seen so far rate cuts in Canada, in the US, in some LATAM countries, in Europe, in Asia, including China. I think this is one of the key components explaining our bullishness for 2025. Usually when you have, I would say, a broad easing cycle around the world, it takes time, but it tends to boost world growth. The US is already in good shape. When you look at the US economy, I think consensus is looking for around 2% GDP growth in 2025. I think that could be exceeded. Fed will ease probably a couple times next year, maybe 2 to 3 times max. That's probably less than investors were envisioning just a few months ago because the economy is probably performing better than they were expecting, and inflation is a bit more sticky. But clearly, easing will continue in the U.S. economy, and the Fed will provide monetary stimulus. So that keeps us bullish for the U.S. economy. The consumer is in great shape. You had a huge wealth effect last year. If you looked at the increase in value for the bond market in the U.S. plus the increase in value for the equity market, that's huge. And that's going to be supportive of consumer spending in 2025. Job market is still doing quite well. Wage growth is robust. That should be, again, supportive of consumer spending. Home prices have started to rebound. So I think you have a decent setup where the economy should perform relatively strongly, maybe better than the consensus, as I mentioned, is expecting right now. As I said, the consensus is around 2. Wouldn't be surprised if we see stronger GDP growth than what is currently envisioned by economists. We might have tax cuts this year with the new Trump administration. So that's a good setup for S&P 500 earnings. The key driver and the long-run driver for the equity market is how profitability is doing. Earnings will likely continue to rebound in 25. Consensus is looking for something like 12-13% earnings growth. That's certainly achievable if the economy performs as we speak. Valuation is on the high side. When you looked at the S&P 500, clearly the S&P is trading at 22 times, but I think if we have easing, that's probably sustainable.
Okay. Next point you talk about is abundant liquidity looking for a home. By liquidity, you mean there's lots of money out there looking for places to go?
Yes, absolutely. There are a few components to this. When you looked at what I call excess deposits in the financial system, banking system in the US, you could see that historically this is going up smoothly. Like reserves tend to move up, liquidity tends to move up, savings move up slowly. But since the pandemic, those deposits have massively increased, or they're not back to what we call trend levels. They're still well above trend, and that means that businesses and consumers still have liquidity in their bank account to spend essentially. That's component number one. On the investment side, when you looked at the US money market, you have over $6 trillion in the US money market. Out of those $6+ trillion, you have almost like 2.5 to 3 trillion belonging to retail investors. And again, with the Fed expected to trim its benchmark rate further in 25, the return profile of cash will diminish because it's tied to short-term rates. Right. Short-term rates declining, cash will generate lower returns in 2025. So with the risk or the return profile deteriorating for cash, I would say investors could be tempted to reallocate that cash into assets with, I would say, superior risk return profile. And that might be supportive of equities in 25.
Right.
In Canada, we see similar stuff in the sense that we still think that retail investors have decent cash reserve that could move the needle too.
Okay. So both on the consumer side, there's a fair amount of liquidity. So consumer spending continues. It's always good for the economy. And on the investor side, there's money to be invested that's looking for a place to go, which also helps businesses to invest in their own businesses and spend more money as well, presumably.
Correct.
Okay. The next theme was U.S. equities. Uptrend extends, but diversification needed. What do you mean by that? I'm assuming it means maybe moving a little bit away from the Magnificent Seven into some other places.
Absolutely. When you looked at, well, we discussed a bit earlier about what we were seeing for U.S. stocks. I think we have more upside coming from a strong economy, rising earnings. So for the S&P 500, we could see further upside. That said, when you looked at 23 and 24, the Magnificent Seven stocks massively dominated, and that was more difficult for smaller caps, mid-cap stocks. Even the S&P 500 equal weight index strongly underperformed the S&P market cap weighted index. So what we're suggesting in 25 is that diversification out of the Mag 7 could be needed. One of the key reasons for this is the earnings growth divergence that was very visible in 23, 24. The earnings growth gap could narrow between the Mag 7 and the rest of the market. So back in 2024, Mag 7 earnings growth was way, way stronger than the rest of the market. In 25, the Mag 7 stocks will continue to outgrow on the earnings front, but this gap, the earnings growth gap, will be smaller than it was last year. And given valuation, I think that could help the rest of the market to do probably a bit better, being a bit more competitive versus the Magnificent Seven. So yeah, that's what we meant by diversification is needed. It means that yes, you want to own U.S. equities, but within the U.S. equity market, maybe smaller cap stocks, mid cap stocks, the S&P equal weight could do on a relative basis probably better, or at least as well as the S&P 500 market cap weighted index.
I see. So, I mean, that sort of blends into your next point, which is size trade. Will U.S. small caps hit a home run or grand slam? Basically, will investment money be slightly more evenly distributed across different sizes of companies in the U.S. as opposed to concentration in those 7 giant companies?
Correct. If you looked at the Russell 2000 or S&P 600, which are small cap benchmarks in the US, they really underperformed in the last few years. They underperformed the large caps and they underperformed massively the mega cap stocks. But why small caps should do better? I think we need a couple things. We need firmer GDP growth, strong economic activity to help small businesses because they're more sensitive to economic conditions. So we need decent growth, strong growth in 25. That's condition number one for small caps to do well. Condition number two, I would say, it's on the cost of debt, if you will. We need lower interest rates. Once again, when Apple needs or any Mag 7 stocks need to borrow money, it's not a problem. Right. But if you're a small mom and pop shop in the Russell 2000 or the S&P 600, credit conditions matter a lot. Right. By credit conditions, I mean, is it easy to access credit? So when you go to your bank branch, is it easy to get money? And what about the cost of money as well? Right. So on both front, if the Fed is easing its benchmark monetary policy in 25, I think the cost of credit will come down. So it's going to be less costly to borrow money. That's number one. And eventually, I suspect with decent growth, bankers will probably make it less difficult for small businesses to borrow. So if we have strong growth and credit conditions were to improve at the same time, 25 could turn out to be a great year for small cap stocks, especially that from a valuation standpoint, the discount between large cap and small cap is quite wide. The discount that we're seeing now, I think it happened a couple of times in the last, I would say 30 to 40 years. So small caps are trading at big discount to large caps, but you need something to close that gap. Probably not fully close the gap, but at least to see a re-rating. And those two conditions, as I mentioned, stronger growth and cheaper and easy access to credit. I think if we have that, small caps will do well.
I think you've mostly been talking about U.S. markets in general there. So we'll move on to your next theme, which is Canadian equities. And what you put there in your theme was banking on financials. Maybe you can explain that.
Yeah, sure. Canada will benefit by extension from solid U.S. economic activity. When you look around the world, I think North American stocks are well positioned to lead. So that includes both Canada and U.S. versus their global peers. Within the Canadian equity market, I suspect the TSX will end 25 in positive territory, generating positive performance. But within the Canadian equity market, I think banks and financials could do quite well. The Bank of Canada has been much more aggressive in terms of monetary easing versus the Fed. I think that the BOC will continue to ease its monetary policy in 25, and eventually that could help Canadian consumers to spend more. For a bank, what does that mean? It probably means that if the Canadian economy do well, the PCL will just improve. Growth will be better. It means probably stronger mortgage growth because people will be able to afford or to renew their mortgages. Probably loan growth overall better. Maybe some capital market activity, M&A, IPOs could help Canadian banks as well. So again, and the bar to beat is quite low. When you looked at the consensus earnings outlook for the banks, what Bay Street is expecting in terms of earnings growth, it's on the low side. I think that could be exceeded. Banks are not very expensive by historical standards. So if you have a bit of firmer growth, some positive surprise, and probably some continued re-rating, banks and financials could do quite well in 2025. And that's the biggest sector in the TSX composite. That's over 30% weighting with financials, insurance, banks. So if the banks and financials are doing well, performing well in 25, that's a pretty good start for the TSX composite.
Okay. And I think commodities make up a fair chunk of the TSX composite as well?
Correct.
So where do you see the commodities going?
On the commodity front, the shine is kind of fading in the sense that oil was well into the 80s, has started to moderate. We're probably closer to mid-70s as we speak today. I think that's going to be an okay year, but WTI is probably stuck in the range. But that should still lead to decent profit growth next year for energy companies. Overall, we're more neutral on the space, because we see the WTI prices being more sideways. When you looked at the global supply and demand picture for oil, we still expect decent growth. That should support demand. But on the supply side, Trump wants to pump even more oil in the U.S. Mm-hmm. Canada oil output should grow. You have a lot of OPEC spare capacity, especially in Saudi Arabia. So I think you have a picture where oil could be very high 60s, maybe the low to mid 70s, so stuck in a range. We're not negative on the space, but I think it's going to be more a sideways environment. On the precious metal front, the spike in the US dollar could certainly put some pressure on gold. Not necessarily a lot, but as we've seen recently, gold is off the highs. Could be kind of range bound as well in the 26, maybe 2,700 or so. That's still good news for the companies. You should be able to make money at those levels for sure. But again, in a sideways environment, you probably be more neutral on the space. So that's why in our outlook, we mentioned that for commodities, the shine is kind of a bit fading, if you will.
Right. So no big spikes, but not necessarily any big dips either.
Exactly.
Okay. You did say that both Canada and the United States potentially looking better from an equities perspective than some of our international peers. On the international front, you describe it as a land of broken dreams.
Yeah. Every year we have clients, institutional clients, asking about international equities or saying that international equities are cheap, way cheaper than the US, and it's time to add to position there. But in the last few years, that has been extremely disappointing. International equities underperform when you looked at EFI, especially EM, they all underperform US S&P 500. And quite frankly, I don't think that's going to change that much in 2025. When we refer to EFI, we're talking about Europe, Australia, and Far East. When we're talking about EM, we're talking about emerging markets. So that would include, depends on the definition, but that would include markets like LATAM, markets like China, for instance. Some European countries would be included as well under emerging.
Right.
So that's, as I've been saying earlier, we would prefer to stay closer to North America in terms of regional equity allocation and be probably underweight EFI and kind of market neutral on EM. On the EFI side, like, as I mentioned, like all international stocks look cheap versus the US. What matters more is the earnings momentum. When you compare the US earnings to, I would say, international stocks or the rest of the world versus the US earnings are rising way faster than the rest of the world. And this is explaining why we're still bull US equities versus rest of world. And that explains also why US stocks have massively outperformed international stocks over the last, I would say, more than a decade ago.
All right. I'll just ask you one last question. That is about bond markets, which have, like everything else, seen some fluctuation. Where do you see that going this year?
Yeah, if you looked at 24 bond indices in Canada, US generated very low performance, low single-digit performance on a total return basis. And quite frankly, we're not super optimistic for 25 as well. I think that's going to be positive performance, but once again, the performance will be mildly positive because we think bond yields, US 10-year yields and US bond yields will stay on the high side in 2025. Within the bond market, we would prefer corporate over treasuries or corporate bonds over government bonds, if you will. On the corporate side, strong earnings, strong economy, and risk appetite should keep corporate spreads very tight. And on the government bond side, I think the higher bond yields and probably some fiscal concern if treasuries, government yields were to rise a bit more, could put some pressure on government bonds.
Okay. Just to finish off here, your report was quite long and detailed and had lots of graphs in it and all this, so it is perhaps unfair to ask you to summarize it, but I'm going to do that anyway. What are the main takeaways that you think people should have from your report? And I guess part of it is your order of priorities, I think, in declining order is equities, bonds, cash. Maybe is that one of the bigger takeaways?
Yes. Base case, solid growth is expected, solid economic growth due to monetary easing that should continue. The main risk on the outlook as we speak are the tariffs. If we have a lot of tariffs, that could certainly derail our scenario, but the base case is some tariffs plus monetary easing, tax cuts will support the economy, support earnings growth. That should continue to push equity prices higher in 25. We prefer equities over bonds, as I mentioned. We see lower returns for bonds. Within the equity market, in terms of regional allocation, I would say stay closer to North America. This is where you have best growth, maybe more positive GDP revisions versus Europe versus Asia as well. Even though North American and US equities are expensive, they are expensive for a reason. Mm-hmm. So we prefer North America over rest of world. Maybe small caps have a decent year this year, so keep an eye on that. And I think that's pretty much it.
Hugo, thank you so much for joining us. Really appreciate it. Always great to have you on the show.
It was my pleasure.
I've been speaking with Hugo Ste-Marie. He is Director of Portfolio and Quantitative Strategy in Equity Research at Scotiabank.
Thanks for listening to Scotiabank Market Points. Be sure to follow the show on your favorite podcast platform. And you can find more thought-leading content on our website at gbm.scotiabank.com. This communication does not constitute investment advice or any personal recommendation to invest in a financial instrument or investment research. This communication is provided for information and discussion purposes only. An investment decision should not be made solely on the basis of the contents of this communication. It is not to be construed as a solicitation or an offer to buy or sell any financial instruments and has no regard to the specific investment objectives, financial situation, or particular needs of any recipient. The information in this communication is based on publicly available information, and although it has been compiled or obtained from sources believed to be reliable, such information has not been independently verified, and no guarantee, representation, or warranty, express or implied, is made as to its accuracy, completeness, or correctness. Past performance or simulated past performance is not a reliable indicator of future results. Forecasts are not a reliable indicator of future performance. Please refer to our legal disclosures on our website.